Hi, Frank and Josh here. The last video that we released a week or so ago, we shared our thoughts on why we favor using indexed ETFs to build portfolios, talked about lower fees, and again, if history repeats itself, better performance over the long run relative to actively managed portfolios. This week, we'd like to drill down a little bit and talk about philosophy and process. How do we build portfolios for individual clients, reflecting the customization that each client gets, and then how, once that customization is in place, fixed income versus bonds, how do we populate those allocations to reflect our macroeconomic views and views to valuation in specific sectors?
Right. And I think maybe to start here, one thing just to think about is what's home base, right? And so if you're making decisions around how to build a portfolio, there should be some thought process around, well, what would you do if you had no opinions, right? So, and the reality there is you'd probably just want to own the whole market, right? If you didn't have any opinions about what was cheap or rich or what was more attractive or not, you'd probably just want to own the whole U.S. stock market. So when we think about portfolio construction, that's where we start. We think about what the U.S. market looks like, what the different weightings are for the various sectors and styles that are in the market, and even drilling further down, when you own funds, how much of each individual company do you own through those funds? So we want to be conscious of that going in, and then we can build a strategy around that by, as Frank said, thinking about our views on the macroeconomy and looking at valuations and thinking about what we see as either attractive or not in the market on a relative basis.
And so to put specificity to what Josh just said is home base on the equity side for us is the Russell 3000, which is the largest 3,000 companies by market cap in the United States. And on the fixed income side, it's the aggregate bond index, which is effectively the entire investment grade bond index for the United States, including treasuries, agency mortgage-backed securities, investment grade corporate bonds, which is BBB or better corporate bonds, and then a few smaller sectors in asset-backed space and so forth. But that's home base for us. And then within individual portfolios, what kind of decisions do we want to make relative to that?
Right. And so, maybe just using some examples from recent portfolio construction to illustrate how we think about that. So last year, as interest rates are rising and we're starting to see, persistent inflation, that had a negative impact on growth stocks. So a lot of what we were thinking about is how do we change our portfolios or adjust to that new reality where you're coming off a long period of time where interest rates are really, really low, policy is really loose. And so that's providing a huge tailwind to growth. That whole dynamic changes. So what do? Well, we think about how do we add more value stocks, dividend-paying stocks to the portfolio. So that's sectors like healthcare, consumer staples, and finding ETFs that, getting back to our last video, hit those sectors and allow us to put that kind of exposure in portfolios in a really efficient and low-cost way so that we can get it into everyone's portfolio quickly and in a way that is not only efficient from a cost but also a tax standpoint for taxable portfolios.
There's so many sector decisions, and again, as we brought up last week and will again here, with the evolution of the ETF market, I'm not sure exactly how many are out there, but I think give or take 3,000 ETFs in the marketplace that provide some very, very broad, where you can buy the entire U.S. stock market as an example in one ETF, and all the way down to very minute sectors where it might be only a handful of securities, but still at their market cap weightings. Based on valuations, we can then, valuations among other things in our macroeconomic outlook will create overweights and underweights relative to that benchmark Russell 3000 index that I mentioned earlier. On the fixed income side, again, as Josh mentioned, with interest rates rising last year as an example, we were significantly shorter duration than our benchmark. And in fact, I think the point that we made at the end of the year as well, kind of favoring treasury bills at this time, yielding more than 5%, full faith and credit of the U.S. government. that's actually getting outside the ETF space. One last thing, international versus national, that's just another broad distinction. And as we brought up in our year-end video that we shared with you, we decided more than a year ago to underweight our international exposures.
Right. And so I think maybe just kind of bring this home a little bit here. The point is that we want to be able to try to add value around the broader market and do that in a way that is very much risk controlled. So when we think about how much to put into each of these sectors and each of these styles and how far to deviate from where the US market is, for example, we want to really be conscious of not going too far afield, because at the end of the day, part of this argument around using passive ETFs is that it's very hard to predict the future, and being consistently right is harder than people think. So you have to acknowledge and have, I guess, the humility as an investor to understand that there are going to be times where you're going to be wrong. And when those times happen, you want the damage caused by that incorrect decision to be fairly limited. So we also think pretty hard about what our exposure is relative to the index and on an absolute basis, and just make sure that we're comfortable that that exposure doesn't expose our clients to too much risk in either direction.
Yeah, I think you bring up a good word, which is humility, which is very important, I think, for an investor to have. Hubris leads to too much risk frequently. We've both seen it over the course of our careers, and too much risk can lead to very detrimental outcomes. I think in closing, the point that we wanted to make here is, as Josh said at the get-go, this is not a set it and forget it strategy. Just because we're using passive vehicles doesn't mean we're entirely passive. We're using passive vehicles to build portfolios. You get better diversification, better liquidity, and we're also building in tilts, as I think of it, tilts into a portfolio that reflect desire to have higher dividend-paying stocks, or companies that grow their dividends, as examples. Shorter duration on the fixed income side, as we've already shared. We're aware that these are fairly complex topics. We're trying to make some of these issues clear via these videos, but we'd love to talk with you about it if you have interest. We both thrive on creating clarity for our clients and our prospects. We're here in Shelburne, ready to meet certainly with our clients and prospects as well, if and when you'd like.